All right, let's dive into a really interesting case study today, Nava Ltd. Now, this is a company that, by all accounts, has been firing on all cylinders. But here's the thing, and it's a big one. A fantastic company doesn't always equal a fantastic investment, at least not right now. And that's the puzzle we're going to try and solve.
So how is it possible that a company posts record profits and that could actually be a warning sign for someone looking to buy the stock? It seems totally backwards, right? But what if all that fantastic news, all that success, is already reflected in the stock price, and maybe even a little bit more? That's the heart of the matter.
You've basically got this tug-of-war going on. On one side, you have the good news. The company's fundamentals look amazing, with incredible profit growth. But on the other side, you've got the bad news. The stock market has slapped a very expensive price tag on it. We're going to look at both sides of that coin.
Okay, first things first. Let's dig into the good news pile. You have to understand why people are so excited about Nava to begin with. And honestly, the numbers themselves tell a really compelling story. Let's start with this number, 18.7%. That is Nava's compound annual profit growth rate over the past 5 years. Just let that sink in. We're talking about growing profits by an average of almost 19% year after year. That kind of consistency is exactly what gets a company on every investor's radar.
And this isn't some story about past glory either. 490 crore rupees. That was their net profit in just the first quarter of fiscal year 26. That is the highest quarterly profit they have ever recorded. It shows the momentum is still there, right now.
And it's not just about profits, it's about financial health. The company is sitting on a net cash position of 1,400 crore rupees. So even after paying out dividends and handling their business, they have this huge cash pile. What does that mean? It means they have flexibility, they're stable, and there's a whole lot less risk involved.
So what's the plan for all that financial strength? Well, management seems to be doing all the right things. They're giving back to shareholders with a solid dividend, they're smart about where they put their money, they're keeping costs down, and they're looking for new growth opportunities overseas. This is the textbook definition of responsible leadership.
So, the company is solid, performance is great, case closed, right? Time to buy? Well, not so fast. Because for an investor, that's only half the story. Now we have to flip the coin over and talk about the price you actually have to pay to own a piece of this company.
And this is probably the question on your mind right now. If the business is this good, what's the catch? And the thing is, the problem might not be with the company at all. The problem might be with the stock's valuation. In other words, how much are you being asked to pay for those awesome profits?
A really quick way to check this is with something called the price-to-earnings ratio, or PE. Think of it as a quick tool to compare apples to apples. It just tells you how many rupees you're paying in stock price for every 1 rupee the company earns in profit. Generally, a lower number is more attractive.
So let's see how Nava stacks up. Its PE is sitting around 14.5. Now that number doesn't mean much on its own, but look at a big competitor like NTPC. Its PE is lower at 13.9, and analysts are calling that very attractive. All of a sudden, you can see why that overvalued tag is getting thrown at Nava.
And here's where it gets even trickier. Yeah, that last quarter was a record breaker. But if you zoom out and look at the year-over-year trend, that explosive growth is actually starting to level off. When you've got slowing growth on the horizon, plus the chance that some tax benefits might go away, well, it gets a lot harder to justify paying a premium price for the stock today.
Okay, so let's try to connect these two big ideas. We've established that Nava is a fundamentally strong company, but we've also seen that its stock has a really high price tag. So, how did we get here?
Well, here's how. Take a look at this. Over the past year, Nava's stock price shot up by an insane 57.8%. Compare that to the broader market, the Sensex, which grew just over 6%. When a stock goes on a run like that, a ton of future optimism gets baked into the price really fast.
And that's the absolute key takeaway. The stock's own incredible success is what's causing this dilemma today. If you got in a year ago, congratulations, you did incredibly well. But for someone looking at it today, the big question is, has the price gotten way out ahead of what the company can realistically deliver in the future?
So, where does that leave us? Now, I want to be crystal clear. What follows is not financial advice. We always say you absolutely have to do your own research. What we're offering here is a mental model, a framework for how you might think through a situation just like this one.
You can think of it as a simple 4-step process. First, you appreciate the company's history and its quality, what makes it great. But then, and this is crucial, you have to scrutinize the price. You have to separate the exciting story from the valuation. Third, you compare it to other options out there. And finally, here's the hardest part for most people. If the price just isn't right, you have to have the discipline to wait.
This quote from our source material just nails it. There are literally thousands of companies out there. There is no reason to feel like you have to rush into any single one. Patience is probably the most underrated tool an investor has. You can always afford to wait for the right company at the right price.
And that kind of leaves us with one final question to think about. It's so easy to fall in love with a great story, but it's paying the right price that often makes or breaks an investment. The real skill is balancing both. So, for your next investment, which one are you going to focus on more? The story or the price tag? Something to think about.